Welcome to the Finance Garage podcast, your go-to podcast for navigating the world of finance. I'm Jonathan, your financial guide, bringing the latest market trends, investment strategies, and financial news that matters to you. And by the way, I'm also going to share my other passion, which is cars.
At the SWU Group, we help everyday families achieve financial success. Our integrated services include financial planning, accounting, credit advisory, and estate planning. We're here to guide and support you every step of the way, from custom investment strategies to maximizing tax efficiency. We ensure your financial goals are met with peace of mind. Visit simonwu.com.au for more information.
Back to the Finance Garage, where we pop the hood on your finances, fix that weird knocking sound in your retirement plan, and make sure your money goes the distance. As always, Jonathan Wu here, Principal and Senior Financial Advisor at the SWU Group, and today we're talking about a sneaky little gremlin in the retirement engine called sequencing risk. Here's a bit of the nerd in me. You might think sequencing risk sounds like some sort of lost Star Wars spin-off. Nothing to do with lightsabers and everything to do with whether you'll be living on caviar or canned beans in retirement. So let's get into it. To like, subscribe, and follow the Finance Garage podcast on your favorite platform. Right now, we are on Apple Podcasts as well as Spotify. Furthermore, we are now hosting our podcasts on the SWU Group YouTube channel. On earth is sequencing risk? All right, imagine you've just retired, you're 67, fit as a fiddle, paid off your mortgage, and you've got $1 million sitting in your super fund or investment account. Now, if you've done it right, most likely it should be in your super fund, and considering converting it to pension phase, or you already have, you've already drawn down, say, $50,000 a year for your lifestyle, and life seems to be pretty good. Because this is where a lot of my clients ask me, what type of money do I need to be in a comfortable retirement? And I say, well, the full age pension, if you have literally no financial assets outside of your own house, you'd be looking at about $40,000 a year for a couple. If you want a basic sort of life, you generally need about $55,000 a year. If you want a comfortable retirement, you're looking at about $75,000 a year. So 50,000 is already on the lower side, but let's run with that. So you've got this $1 million sitting there, drawing down $50,000 a year. Life seems pretty good. And then bam, the markets crash. We have a global recession and interest rates spike. China slows down, or maybe Elon Musk tweets something that tanks the entire tech sector again. Overnight, your $1 million portfolio drops to 800K. Now here's the kicker. You still need to withdraw the $50,000 a year to live on, but that withdrawal now represents a much bigger chunk of a much smaller pie. And that's the truth of the matter. And when markets finally bounce back, your portfolio actually has less firepower to recover. That, in a nutshell, ladies and gentlemen, is sequencing risk. It's not just what the market returns over time, it's when it returns them that can make or break your retirement. Let's make this a little bit more real. Let's meet Margaret and Brian. Now, Margaret retires in 2008, the year, for those of you that have a long enough memory, the global financial crisis. Now, Margaret's done everything right. She's saved hard, she has $1 million portfolio and wants to withdraw that $50,000 a year. Then the GFC hits. Her portfolio drops 25% in 2 years. She still needs to draw that $50,000 each year, but now she's down to 700K. Not only that, she's now locked in those losses as well. Even though the market recovers a few years later, Margaret's portfolio doesn't fully bounce back and she's drawn too much too early. Now Brian, He instead retires in 2013. Remember, Margaret retired in 2008. He's got the same $1 million, the same 50K lifestyle withdrawal he needs. But for the first 5 years, the market goes up, and by the time the next downturn comes, Brian's portfolio has grown to 1.3 million. Now, he's cruising through retirement, doing river cruises in Europe and buying weird gadgets on Temu. Same savings, same investments, and same lifestyle goals, but completely different results, just because of timing. Now, why does this matter more now? Well, let's face it, most of us aren't retiring with a defined benefit pension anymore. That's very, very old school. It's DIY super, right? Your employer contributes money and then you do extra top-up contributions to hopefully make your retirement savings grow. Your future lifestyle is tied to your investment balance and how long that investment balance lasts. You then have to add in the cost of living crisis, a volatile market, longer lifespans, and more retirees entering the market at once. And then suddenly, sequencing risk isn't just a theory, it's reality, and it could affect millions of Aussies in the next decade, especially if we consider that equity markets have been, in broad terms, performing really, really well.
Ready to take the first step in investing, or just looking to continue growing your wealth without being inundated with financial information? With SWU Online Invest, we offer a range of expertly managed portfolios designed to match your investment needs. Whether you're a seasoned investor or just getting started, know that we will work tirelessly to ensure your investments are strategically positioned to maximize your goals. Visit swuonlineinvest.com.au today.
Talk about strategy and how do we actually beat sequencing risk? All right, first let's stop the solutions, because sequencing risk is sneaky, but it's not unbeatable. And there's a number of tools in your toolkit that you need to consider addressing sequencing risk in your own personal situation. The first consideration is creating a bucket strategy or a cash wedge. Now, this is the financial equivalent of keeping snacks in the glove box during a road trip, right? This is your backup. So your retirement, or you segment your retirement money, or you segment your super fund into different buckets. Now, a lot of the different technologies that we use with our clients nowadays can segment it into those buckets. Now, your first bucket, and let's call it 3 buckets for some of our clients that want to deploy this sort of strategy to give them more peace of mind and allows them to sleep better at night, is that we split their money into 3 individual buckets. The first bucket is worth 1 to 3 years of living expenses, and this just sits in cash or term deposits. We then have a second bucket, which is what we call medium-term money, and this is invested in more low volatility investments. This could include bonds, private credit, other more focused on income generating type investments. And then we have a third bucket, which is the long-term growth bucket, which is your equities, your commercial property, stuff that's a little bit more sexy, stuff that's a bit more volatile, but you're not going to worry about it as you're going to be invested in bucket 3 through the market cycle. And so that way, when markets fall, you don't touch the risky stuff and you just continue to draw from bucket 1, which is your emergency comfort food. This allows you time for your growth assets to then recover without you having to draw down on them specifically. The second strategy you could consider is staggering your withdrawals. Now, you don't need 50K a year from day one, so you shouldn't take it. You should be flexible. You can split the 50K into monthly payments. Some platforms even allow you to take it down to fortnightly. Because retirement in itself is not one fixed number, it's actually a journey. And early on, maybe you're spending more on travel, and later you might slow down. In my experience, in my 20 years as an advisor, I usually see clients travel a lot more once they're retired, all the way to about early 70s. And I'm talking about 72, 73, and then I start to see them materially slow down because they're just getting tired. And so the trick with your withdrawal strategy over time is be dynamic, right? If markets dip, then slow down with your withdrawals. If they soar, then loosen up a bit, little, and you should ride through that cycle. Don't fixate yourself on having to take it every month or having to take it every half year. Look where the market sits and then assess from there. The third strategy is consider retiring gradually if it's possible in your situation. Because a lot of people think of retirement as a light switch. It's very binary, it's 0 or 1, like a computer program, it's on or it's off. Again, over my 20 years of being an advisor, I can share that for clients that I see that retire gradually, they actually have a better standard of life. The reason why they have a standard better of life is because they're continually being stimulated. They don't want the stress of having to work full time, but doing 2 days a week, for example, allows them freedom to do the things they want to pursue. They still have some money coming in and they are stimulated. Those clients that I see that simply retire from 5 days a week down to 0, unless they have a diversified portfolio of extracurricular hobbies, their cognitive function deteriorates at quite a fast pace. So this is the one thing I always talk through with clients when we have our reviews and discuss what does retirement look for them and whether or not it's gradual or it is something that phases out over time. Okay, you might, if you're in the professional services, you might consider doing some consulting. I have many friends that have done this. Even earning 20K a year for an extra few years can delay the need to draw on your capital and then therefore reduces your exposure to sequencing risk in the riskiest period. Plus, let's face it, it gives you something to do that isn't just mowing the lawn and waiting for your next TV show to release the next episode. Strategy 4 then considers diversifying across different assets and income streams. So if you got all your eggs in one basket, like Aussie banks or property trusts, then a downturn in that particular sector of the market that you're invested in can hit quite hard. You should mix it up. Add some global shares, maybe add some infrastructure, private credit, alternatives. As long as you understand what you're investing in and you understand the dynamics and what market environment is conducive to that type of asset class or that style of investment to perform well or perform poorly. Different assets move differently, which helps smooth the bumps. Now, number 5, which I think is the most important, and yes, I'm biased because I'm a financial advisor, but sequencing risk is not a do-it-yourself friendly beast to deal with. A good financial advisor can help you build a buffer. We can help you plan your drawdowns and we can stress test different market scenarios to consider what you are most fearful of in retirement. And to be honest, 50% of my job is to help you avoid emotional panic and especially emotional panic sell when you're at the bottom of the market. If your advisor has never mentioned sequencing risk to you, then you should definitely ask them. Now let's talk psychology for a second. As I said, that's half of my job. Now, when markets fall and you're drawing from your super, it feels like it's a double whammy because your balance drops and you're still spending money. And that combination of those two things can trigger fear-based decisions, including selling everything, switching to cash, stopping all spending, and basically slamming on the brakes mid-highway. But with a plan in place, like a cash wedge, giving yourself some flexibility, creating a diversified portfolio, really you don't need to panic. So Donald Trump, we have no control over what type of tariffs he's going to hit next, but it means that if you're well diversified and you know in different scenarios how your portfolio performs, then you won't panic. You can ride it out and you are confident that whatever market blip we're going through now won't derail your retirement. So to sum up today's episode, remember, number 1, sequencing risk is real and it's the most dangerous in the first 5 to 10 years of your retirement. Number 2, remember that it's not about what returns you'll generate over 30 years. It's about when those returns come that's more critical. Number 3, you can manage it with structure, diversification, cash buffers, and good advice. And finally, number 4, don't leave it to chance, because remember, your retirement and your superannuation is your life savings, your freedom, and your future cruise fund. And if there's one thing I want you to remember from today's episode, it's this. You only ever get one shot at retiring well, but that shot can land differently depending on the sequence. So plan like the market's going to crash the day after you retire, and if you have that in mind, you'll be ready no matter what. So with that, thanks for tuning in today's episode, and hope to see you at the next one. See ya.
This podcast is not financial product advice and is intended to provide information only. It does not take into account the investment objectives, financial situation, or needs of any person. You should assess whether the information is appropriate for you and consider talking to a financial advisor before making any investment decisions. Any investment examples are for illustrative purposes only. The information is taken from sources which are believed to be accurate, but Simon Wu, Jonathan Wu, SWU Financial Planning, and Personal Financial Services Limited accept no liability of any kind to any person who relies on the information contained in the podcast. Unless expressly stated, none of the information should be taken as a recommendation. For more information, please visit www.simonwu.com.au.